What's going on, everyone? Welcome to Real Talk Real Estate. This is the David Green Show live. I'm David Green. He's Christian Batchelder. We're going to be talking about everybody's favorite topic, the 50-year mortgage. Is it of the Antichrist, or is it of the Messiah, or is it somewhere in between? Everybody's got an opinion on this, and we're going to be talking about how the wise people will look at this, how to keep your head when everyone about you is losing theirs, and how to decide if you should get a 50-year mortgage or not, since we're going to be issuing them if they pass. Christian, thanks for joining me tonight. How are you?
Absolutely. It's weird to be recording at nighttime. I feel like all the lighting's different. I'm a little off my juju here, but it's good to be doing another episode.
All right. Well, most important question, is the mortgage mutt still around this time of night?
He is looking out the window right now. Let's do a little peek at him. Got him right there.
He wants to know about 50-year mortgages.
That's right.
Turns Taco, who frequently attends my lives and always says funny stuff, says also he has a cool Spartan logo there, which is going to make me like it. If you guys want to know about my mastermind Spartan League, it's a faith-based group. Just send me the word faith on Instagram. I'm at David Green 24 while you're listening to this, and you'll get some free information there. He says the 50-year mortgage, in Latin, that means ultimate death contract. So we already see what he thinks.
Technically, mortgage, people don't know what mortgage means. Morton comes from the two Latin words that actually mean death contract. So that's actually exactly what Turns Tacos is saying right there. The word mortgage intrinsically means death contract because mortgages used to be until you die. So fun fact, you guys don't know that. But
Turns Taco, you are a scholar and a poet. I had no idea. And this is why we have Christian on live right now. Usually I'm the one bringing useless information into the group, but
no, come on.
Christian does it tonight, giving me a run for my money. Also, you got a little Spartan American for Veterans Day there. Eric Jones, thanks to see you. He's in my mastermind. If you guys are interested in joining a real estate mastermind, which is sort of group therapy at this point for all the people crazy enough to be working in real estate, we would love to have you in there. Christian attends that as well. And we're going to be talking about everything you've heard, maybe some things you haven't heard. And just to be honest, we're going to make it as entertaining as we can. But at the end, we're going to break down for you how to know if you should get a 50-year mortgage, how to know if you should avoid it. And to be completely honest, why much of this is clickbait and people making a really big deal. Now, Christian might have a completely different opinion, but in my opinion, this is probably going to be a nothing burger at the end of the day. Just a fun thing for us to all talk about. It's like, okay, we invented another tool. It's not a screwdriver. It's not a drill. It's a drill driver. And everybody has to talk about it at Home Depot. We're going to be getting into that. So as you guys are listening, please comment and we will do our best to respond to them. Let's get into the first video. And Christian, if you wanted to share where people can get a hold of you during the recording, go ahead and do that while I pull up the...
Yeah. Best way to always catch me at the One Broker on Instagram. That's the social media I'm the most frequently on. My email is christian@theonebrokerage.com, and you can always find out more about our company at theonebrokerage.com. That kind of has a nice summary of the products we offer, what we do, who we are. If you guys are listening to this, you probably know who we are. But if you're ever looking for more information, that's a good place to go.
All right. First thing that we're going to observe here, Trump is already doing the hand thing. He's caught out. And I will have to admit, his hands look pretty small.
Oh, don't tell him that.
I know. This is a hot button topic. Trump has been accused of having small hands. He doesn't like it.
I have the biggest hands, David. The best hands, the biggest hands. Everybody knows this.
He started doing this thing when people criticize his small hands because it's like, look at them, they're not that bad.
He's like really spreading them out, like the best, the biggest.
I don't know why they say this. My hands are amazing. They're tremendous. Some say they're the best hands in the presidency. They're certainly better than Biden's hands were. We wouldn't even be here if Biden's hands were normal sized. All right, let's get into it.
This morning, new backlash as the Trump administration moves forward with a plan to introduce 50-year mortgages.
It looks to be like the president's looking for a quick fix to a market that is fundamentally broken right now.
Over the weekend, Trump sharing this image comparing the proposal to the 30-year mortgage policies championed by FDR nearly a century ago. The move could potentially kickstart the now stagnant real estate market. Homes are currently seeing the lowest turnover rate in 30 years, and the median age of first-time home buyers just hit an all-time high high of 40 years old.
It's really difficult to see right now for younger borrowers how they are going to be able to afford a home.
A longer fixed rate mortgage would lower monthly payments, but would also create a higher total cost because of all that interest over 5 decades. Take a $400,000 loan at 6% interest. Under a 30-year mortgage, the monthly payment would be just shy of $2,400. Under a 50-year loan, it drops to just over $2,100, a savings of nearly $300 a month. But over time, that savings is erased by a much larger interest bill, because while the total interest on a 30-year loan would be about $463,000, the interest on a 50-year loan would total more than $860,000. Many, including longtime allies of President Trump, are not on board with the idea. Congresswoman Marjorie Taylor Greene saying, quote, "It will ultimately reward the banks, mortgage lenders, and home builders, while people pay far more in interest over time and die before they ever pay off their home, in debt forever, in debt for life."
All right, let me go back a little bit here.
Forever, in debt for life. What a sign off.
That's it. I know. That sounds like what a Spartan would say just before they die on the battlefield.
Well, then we will
Right.
fight in the shade.
In debt forever, in debt for life for Sparta. I thought that was funny. Just a quick question, because I don't want to get too caught up. We're going to talk more at the end of these, but how many people have you come across in your short 30-something years of life who have paid off their home and don't have a mortgage at all?
Less than probably 2% of everybody that we talk to. It's a very small percentage.
Yes.
Now there are people, sure. More often it's people who bought it in cash. So people, I think,
Yeah, they never had a mortgage. That's exactly
what
right.
people David's really getting at is not who owns a paid off property; it's who paid off a property. Right.
Right.
That's a very different thing. Most people do not get to the end of their 30-year mortgages.
That's it. So as you're listening to this, if you feel this little welling inside of anger that you're making debt longer by 50 years, it is true. However, how many people really have one mortgage for their entire life? They never refinance it. They never start the clock over again. They never try to get a lower payment when rates come down and restart the 30-year clock. Most people will have some form of mortgage on all their real estate anyways. So let's not get our panties in a wad about this. Let's just look at what we can do if your goal is to pay your house off faster, and if this would be a good option or if it wouldn't be a good option. I just thought this was a little dramatic from Marjorie Taylor Greene.
I will say this too. A lot the people who have paid off their mortgage, a lot of them make extra payments. So like David, we've talked about the extra payment every year, paying it bi-weekly instead of monthly, adding more principal to your payment. But you can do that with a 15-year, a 30-year, a 40-year, a 50-year. You can do that with anything. So, what mainly I'm referencing is the people who held their property paying the minimum interest for 30 years. That number is very small.
Yes.
There's absolutely people that I know that paid off their mortgage. My mom's on a 12-year mortgage payoff plan right now.
Sure.
We did the math, and we said if you throw an extra $1,000 at it every month, then you kick that up to $1,500 once you're in retirement. Like, we've mathed it out, right? But very rarely does that payoff actually facilitate over the course of the originally planned 30 years. It's very rare. Now it happens. Don't get me wrong. Grandma who never refied, who's been sitting in the house since you'd have to be at the early 90s right now, right? For it to be 30 years ago. I don't doubt that there's somebody out there that held a mortgage since 1995 and they paid it off this year. It's just rare. Usually people are one of the alternatives, which is bought it in cash, put a very large down payment and paid it off in a smaller period of time. They're on a 10 or a 15-year fix, or they make substantially higher monthly payments than what the minimum requirement is. Those are more common.
Right. So let's not overreact to just because she has the last name as I do doesn't mean we have the exact same opinion here. This was a bit. She's even got outrageous. I know she does.
Debt for life. And the White House has not yet explained how it would get around the Dodd-Frank Act, which effectively bans mortgages longer than 30 years.
All right. That's our first video here. We basically kind of gave away all the commentary during it, so we don't have to get into that. Let's get into the next one.
In an attempt to make home buying more affordable, President Trump floated this idea of a 50-year mortgage in a social media post. The purpose of a longer-term fixed-rate mortgage would be to lower the monthly payment for homeowners. The longer the term of the loan, the smaller the principal needed each month to pay it off in full. Using the latest median sale price of a home from September, $415,200, according to the realtors, and the current interest rate of about 6.3%, according to Mortgage News Daily. On a 30-year fixed loan with a 20% down payment, the monthly payment of just principal and interest would be $2,056. Now, if you raise the length to 50 years at the same interest rate, that payment would be $1,823, and that's a savings of $233 a month. Homeowners, however, wouldn't build equity as quickly, and that's because their principal payments would be smaller, and the amount of interest that they're paying to lenders would actually be 40% higher. Homeowners could still gain equity through home price appreciation, but home prices have been softening swiftly across the nation this year, with nowhere near the appreciation seen in the years before. Now, even realtors agree that the savings to homeowners would be minimal. Joel Berner, a senior economist at Realtor.com, said in a release, "This is not the best way to solve housing affordability. The administration would do better to reverse tariff-induced inflation, which is keeping the rates on existing mortgages high." The average age of a typical first-time buyer in 1991 was 28. By last year, it had reached 38, according to a new report from the National Association of Realtors, whose deputy chief economist called the number, quote, shocking. Then there's the question of what's the mortgage rate? The average rate on the 15-year fixed mortgage is currently 66 basis points lower than the rate on the 30-year fixed. So this would kind of imply that the rate on the 50-year fixed would be higher. It all depends on investor demand for the product, of course. I spoke with Matthew Graham at Mortgage News Daily. He told me there is not currently a secondary market for these loans, nor would a robust secondary market be cultivated anytime soon.
All right, Christian, the secondary market, she's referring to selling these loans to an investor once a group like us originates them. I found it interesting that there's talk of what do you call it? Decoupling from Fannie Mae and Freddie Mac with the federal government at the same time that we're talking about a mortgage nobody would want. What's your thoughts on if this is like a crazy idea to be introducing a mortgage that'll be hard to sell at the same time that the government isn't helping to sell these loans anymore?
It's a very good question, and one that I think a lot of people haven't put a lot of thought into.
Including you. I didn't give you any chance to think about this. I just threw you on the spot.
Let me equate it to the most similar analog that I have right now. Most people may not know, but there's a 40-year mortgage available right now.
Oh, yeah, that's true. Those were really big in like 2011, 2012.
They still are available in the non-conventional market, which we do a lot of lending within. I'll tell you once again, to bring percentages up, less than 1% of people that we do non-conventional loans for elect for a 40-year mortgage. So it's there. The impact is minimal, right? And most people don't like the surge in interest. So here's honestly what I think. I think depending on the demand of buyers, and the demand of investors, I'm not sure. I mean, there's no demand for it right now because nobody sells them. So it's kind of stupid to say there's not a demand for it right now. Of course there's not. It doesn't exist, right? That's like saying if, Ferrari came out with a minivan, there's no demand for that. Well, yeah, it doesn't exist. Of course there's not, right? Maybe somebody would buy it. Who knows? Maybe somebody's crazy enough. I believe a demand would form, but I think I've done a lot of thinking about this the last 3 days since I saw this post be announced. Mm-hmm. I honestly think the 50-year would be just a reserved program for people who really wanted it. Very similar to how we treat our 40-year mortgages right now. Not a lot of people use them. I think most will still elect to the 30. Some may elect to a 40, just like how when we initiated the 30-year fixed mortgage, we also got 25s and 20s and 15s and 10s. We can do all of those amortization periods. I think this will just be another tool in a tool belt. My concern is if it becomes the standard, similar to how the 30-year mortgage became, because there is a lot to be said. Like, admittingly, coming from, a lender and somebody who, chooses his career path in this field, admittingly, it would open the door slightly for first-time home buyers to have lower monthly payments, to have lower cost of operations. I think the negatives probably outweigh the pros, though. I think the standard will remain 30, with some electing for a 40 or 50, like to save deals. Like right now, we throw a deal on a 40-year loan when the monthly payment is too high to qualify. We do it and we explain it to the borrower and say, here's a way that we can work around you buying this house. It's a little bit less of a monthly payment from you every month. You're extending your amortization over another 10 years. You have to be aware of that. This is how we can get your deal done. Your deal does not work on a 30-year. And that's okay. Some people like to do it. It is the vast minority of loans we do, like vast, right? I just don't think, Roman had a good comment here. Some people will use it. Absolutely. And you're right. You said no equity after 15 years, only positive is rent, just always goes up. Yeah. So for investors, maybe you're interested in using this to provide a little bit more cash flow, but we just saw the numbers. I forget who that first clip was by, David, but some news source, right?
Mm-hmm.
What was the difference? It was like $280 a month. And like, that's a decent amount of money on a $400K loan, but like,
not as much as I thought it would be.
That's what I'm getting at. If $200 is deciding whether you succeed or fail on a deal, like it probably wasn't the deal to pursue anyways, right? I mean, $200 swing should not like I'm drowning or I'm thriving. You know, $200 is the swing there, especially on a $400,000 loan. On a $100,000 loan, maybe, because that's a much bigger, return based on the equity that you put in. But on a $400K loan, to drop your monthly payment by $200, that's not like, it's not crazy to sacrifice 20 more years of payment.
Correct.
Right?
Yeah. I was a little surprised when I saw how the numbers worked out on it. It could have been, I mean, loans are tricky. Like interest rates are a variable. Maybe at lower rates, it's a bigger difference than it is at higher rates. There's also, you got to consider the longer the amortization period, the higher the interest rate.
Correct.
So if you want a 20-year loan or a 15-year loan, we can get you a significantly better rate than at a 30-year loan, but your payment goes up.
Correct.
But a bigger chunk of what you're paying is going to your principal than your interest. So even though you're paying more, in a way, you're paying yourself some of that more because it's coming back as principal. There's a whole chapter in Better Than Cash Flow about how to do this. At a 50-year loan, I mean, that's like a big jump. If you look at the interest rate in general, Christian, just off the top of your head, you don't have to be perfect here. What's the difference on a primary residence 30-year loan versus a 15-year loan right now?
Just under 0.75%. So average 30-year right now is like 6.2 to 6.3. Average 15 years like 5.7 to 5.8. So
by that logic, a 50-year loan would probably be more than 1% higher than a 30-year loan.
It would probably be in the 7%. Absolutely. It'd go from your 30-year fix at 6.3 to probably 7.1 would be. I don't know. This isn't a product that's been.
I would
priced,
think even more than that. Okay,
maybe,
we haven't seen the numbers, but I would think if you're going from 30 to 15, it's a 15 years down, and you're only getting 0.75 point less. You're more than 15 years the other direction. You're 20 years the other direction. It's probably closer to a full point more. So even though you are extending out how long you have to pay this loan off and your payment goes down, your rate goes up, which is sort of working against you. All right.
And that's where a lot of the people criticizing this are saying this is all in the favor of the banks, because technically speaking, if they're making a higher interest rate over a longer period of time, like there's one party benefiting from that drastically, right? So there's an argument to be made there for sure. But these same arguments were made when the 30-year fix came out. I think a lot of people don't remember that, right? I did a little deep dive, and I looked up a lot of old comments and articles and everything that were coming out when the 30-year came out, and very similar things were being said. Oh, I'm going to die before I pay this off. So it's funny to think that like 30 years that are so accepted and normal for us today were thought of in the same mindset when they were rolled out. That 30 years seems like forever, right? Which, like, on an objective basis, like it kind of is. You buy a house at 20 and you're paying it off at your retirement age, right? So
it reminds me of the Gillette commercials where there was like the first time they put two razors or on one razor, right? Not just one, but two. And then they had like the Mach 3 and then they had the Turbo 4. And it was just like, they just kept adding razor after razor after.
I think they tapped out at like 6 or 7 razors. I remember watching that as a kid. I was like, man, how many things can they fit on this thing?
Yeah. And I think Mad TV did like a skit where the guy's like whole face, like the skin was coming off, was going right down to the bone because of all the razors. The 90-year mortgage.
Yeah, there's obviously a place where this just fundamentally doesn't make sense. Maybe that line's going to be drawn at 50-year. If this actually takes hold, and I just want to make sure all the audience is clear, this is not like a set thing. This is a conversation that's being had. There's no acceptance, there's no approval, there's no rollout, there's no product offerings, nothing. It's just a conversation right now. And, we'll see if there ends up being a market for it. And I'm sure Trump's asking his banking friends, would you guys buy this? Right?
Yes, that's that was the original question here.
100%, absolutely, and maybe so. It's hard to tell at this point in time because nothing like it's ever existed, right?
That means that in addition to the extremely low amount of principal paid down in earlier years of the loan, the interest rates would also be quite a bit higher than 30-year loans. He calls that a double whammy for those with any hope of building home equity. Graham also said that for all practical purposes, the loan would be more like an interest-only loan because very few people would keep a home for 50 years. The real question, though, is can Fannie Mae and Freddie Mac actually do this? Now, analysts say it's possible, but a 50-year mortgage does not currently meet the definition of what is called a qualified mortgage, and that's under the Dodd-Frank Act. It gives investors a backup from Fannie and Freddie if that loan goes bad, as in the homeowner doesn't pay. But regulators were given the authority to change that in order to ensure mortgage affordability. That, however, though, could take a year, according to Jarrett Seberg of TD Cowen. That's because they need congressional approval.
Yeah, that's very true.
Which I haven't heard many people discussing. I thought that was like a pretty relevant point there.
They would have to amend the current fair lending laws for Fannie and Freddie loans right now because anything viewed outside of a 30-year fix is a non-conforming product. It doesn't conform to Fannie and Freddie standards. Now, they could amend it. Sure, of course that's an answer. But as of right now, they literally could not roll it out and call it a conventional loan. It doesn't qualify, right? One of the characteristics of a conventional loan, or a conforming loan, I should say, is it's 30-year fixed or less, not more. So like I said earlier, we have a 40-year fixed product. It is a non-conforming product. Those of you that follow the show, DSCR lending, bank statement lending, private money, those type of things can extend up to 40 years. Conventional loans cannot currently, right? Maybe in the future they will. I don't know.
Welcome back. President Trump is shaking up the housing market with his newest plan considering 50-year mortgages for home buyers.
The head of the Federal Housing Finance Agency, Bill Pulte, says the plan is already in motion, calling it, quote, a complete game changer.
Let's break down what this would mean. Right now, a 30-year fixed mortgage on a $400,000 home averages a payment of about $2,038 a month in principal and interest. Stretch that loan to 50 years and you'd pay $1,822 a month, a savings of just over $200 a month. So joining us now, the Ramsey Show co-host, Ken Coleman. It's great to have you. I want to get your take on this because while the payment came down in that calculation, because you are spreading this loan to 50 years and not 30, it's an extra 20 years of interest you're paying on it as well.
This is a horrible idea. The last thing Americans need is more debt. We just saw on the news today that we've now reached another record high for household debt. And all this is more debt. You just laid it out beautifully. We're now going to see, I think in the next 6 months, if we haven't already gotten there, that the average age of a first-time home buyer in America is going to be 40 or older. So let's run this out. You're going to be 90 years of age before you pay off this loan. You're going to die with this debt. You're going to pass this debt on to your kids. All for what? Barely $200 a month in savings. I'm shocked that this is coming out of a Republican White House and the Trump White House. Mr. Pulte knows way better than this. A game changer? Let me tell you who this changes the game for. Banks. Banks love this. Yeah. This is a horrible idea. It's ludicrous.
All right, Ken. Well, I'm obligated to give the other side of the argument, right? Because we're talking about money here. At the end of the day, It does save $200 a month, and that's not really enough. But when you look at a $400,000 home and what the potential rent could be on that $400,000 home, the question is, would it be $2,000 a month? And if the rent is $2,000 a month and the mortgage is $2,000 a month, why are you not in favor of it under that premise?
Because it's debt. I don't care how you play those numbers right there.
Yeah.
Debt is debt. And I have flexibility when I'm renting. See, I'm sitting in the studio where we take calls every day with people that are struggling with debt.
Yeah.
And they get too much house payment, and then they feel stuck. And many times they are stuck because they're upside down in a home. You're not having that with renting. So no, I don't like that comparison. Debt is bad.
Well, Ken, let me make the comparison a different way. The debt balance that you start your 30-year mortgage with and your 50-year mortgage with are exactly the same. So it's not more debt, it's more interest expense over the term of the loan. But the principal balance doesn't change. So how is it more debt?
Because you're paying all that interest front loaded. You know that. And the average home buyer is selling their home somewhere around 11 and a half years. Check me on that, but it's pretty close.
Yep.
And so you're going to have little to no equity at that point. And so I think we're playing semantics, to be honest with you, because that interest, you owe that interest, and it is more interest. If you look at the numbers out there on a $400,000 house, you're looking at several $100,000 more that you're going to have to pay in interest. So that is more debt. And so again, I don't know why we would propose this idea for a mere $200 a month.
Savings a month.
Debt is debt, and debt's bad. And $200 a month, by the way, in today's economy is not going to make that much difference to people who are already burdened with credit card debt, car payments, and the like. Student loans,
really not.
I could keep going.
We made the argument on the Big Money Show earlier today that prices are too high, and that's the real issue. Prices need to come down, whether it's increasing supply or other avenues, reducing regulation to make that happen.
So what are you guys' thoughts here? Is it debt the way they're describing, or is that a weird way of looking at it? Here's what's tricky about calling it debt. It's kind of simple because the government continues to destroy the currency. It's not based on a gold standard. Money isn't real. It's not tied to anything real. The house itself is real. It could have some value there. The asset can retain value, can lose value depending on how it's using the area that it's in, if it's falling apart, if it's in good condition. There's a lot of variables here. But when you don't invest in assets, which you usually need debt to do, you can't build wealth because the money that you have saved goes away. That becomes like a challenging problem. So I kind of like the philosophy that you don't want to take on a lot of debt, assuming that your dollar isn't losing value because the country is maintaining a consistent value of the currency. But if they're going to just continue inflating and printing more money every time a new politician takes office and wants to look good and wants to spur a good economy, all your savings are eroding. So how do you get a house without taking on debt? Can you save up $400,000? I mean, if we just want to think about that, right? To save $100,000, let's say somebody is able to live on $40K a year. And then that means that you'd have to save $140K, but then you're going to have taxes. So you probably have to make about $180, $190K a year. Let's round that up to 200. And then have your basic living expenses. This is just if you're living at home, you got health insurance, you got car insurance, you have gas, you have food you have to buy. You probably got to make close to 200K to save 100K. And even that's almost impossible. You got to do that for 4 years to be able to buy a house. What percentage of the population can even do that? Right? Like the idea of trying to save money to buy a house without debt, your average person can maybe save 15 to 20 grand a year. So now you're doing this for like 12, 13, 14, 15 years. And now you're hoping that the house doesn't appreciate in value while you're doing it. We're talking about like, what is the odds of getting a house without taking on debt? When you think about this, Christian, what's some prudent financial advice that you'd give people that have concerns about taking on more debt to buy an asset?
It's like all things with debt. I mean, there's good debt and there's bad debt, right? So, I mean, if there's good debt, and that could be a primary residence or an investment, right? For an investment property, you know, is the property capable of cash flowing with all of your metrics and margins for vacancy, for CapEx, for maintenance, for management, you know, whatever you have, and it's still providing you money. Now, obviously, you run into the question of what if the tenant moves out? What if they, you know, squat? You know, and sure, there's absolutely risk, just like there's risk of buying anything in the stock market, right? For a primary residence, you know, are you able to purchase and drop your living expenses, right? Can you purchase for less than your rent? Can you purchase a multifamily and house hack, right, and lower your cost of expenses so that you can save that money at a more aggressive clip? You know, so there's yes and no. So I'm kind of giving the cop-out answer, David, but there's a lot of people that I would say you're not in a position to buy, and this is a bad investment. And there's a lot of people that I'd say this puts you, you know, forward in your life in terms of your financial strategy, right?
But the argument that it's more debt and debt is inherently bad is tricky.
Yeah.
because inflation eats up savings. And so if you don't take on debt, it can feel safe, but then inflation eats up what you saved. And you can't buy anything because the price keeps going up with inflation. So you got to buy, but you can't save up cash to buy a house if you're a normal person watching the show. So you got to take on debt. So now it just becomes, how much debt is too much debt? If you can qualify to get a house at a 50-year mortgage, but you couldn't at a 30, this is all hypothetical. And this is like a starter home. We're not talking about a person that's stretching to buy a luxury property that they can't afford and shouldn't buy. Just to get into a market, a C-class neighborhood, a young married couple wants to own instead of rent. There's a couple benefits here. Your landlord's not raising your rent, like whoa Noah said here. Whoa and nah. Only thing I might help people with is your landlord can't raise your rent when they want. So you're getting in at that, let's say $1,800 a month payment when the rent could have gone up every single year for 5 or 10 years. That's one benefit. Maybe you're building equity that you wouldn't have been able to do if you didn't have the 50-year mortgage. In these cases, this is a good idea. Like, your dog definitely agrees with me.
Yeah.
Be quiet about how exciting this is. Now, if you could afford it on a 30-year, and you choose the 50 just to get a little bit less of a payment, that might be financially irresponsible.
Yeah.
You really want that extra $280 a month to go spend it on something stupid. These are people that are in a bad position. Now, I haven't heard anyone give commentary that's objective on it. Every video I've seen is some sensationalist clickbait. This is a terrible idea, or this is a great idea, rather than for which people would this be a good idea?
That's such a better way to look at it. That's 100% right. My fear, I'll be honest, because I'm very hesitant to really give my opinion of the 50-year. I haven't really established which side of the aisle that I line on yet. My concern is that smart people will use it intelligently. It's the same way with interest-only loans right now, right? Interest-only loans are a risky product. I do not believe they are a good fit for probably 90% of home buyers. But there's 10% of people that with the right strategy, the right planning, interest-only options can really fast-track their investment mechanism. It's not something that everybody should do, though. I feel like I'm going to finally settle on my opinion here in the same way. I think 50 years will have a unique ability to help a certain subset of the population. My fear is if they become the standard. Like if Fannie Mae just pretty much around the clock markets their 50-year mortgage product now instead of a 30-year product, I'm having a hard time convincing myself that's for the betterment of the American public. It's tricky because I don't believe it is. Like you said, David, if somebody is that far away from qualifying and that $200-300 a month savings helps, if that's the difference they need to cash flow and they're not thinking of a quick exit, so it's not important if you build equity quickly, you're giving up a lot for sure. But could there be a subset in the same way that 40 years in interest-only loans are right now for knowledgeable, financially savvy, and intelligent investors? Sure. I'm okay yielding that. I don't think this should be marketed to across the board to all first-time home buyers. I think it's risky, and I can't fully bring myself to get behind it.
Now, if somebody called us at the one brokerage and they were like, hey, should I get a 50-year or not? We're not going to say yes or no. We're going to start asking you questions. What's your financial picture look like? What are your goals? Do you want to have a house? Do you want to have a lot of houses? Do you want to buy a new house every year? Are you open to house hacking? What's your job situation look like? Are you going to be working the same job 10 years from now? Or are you getting ready to graduate school and get a better job? What's the market you're in? I can see that if you're in an established market that doesn't move much, a 30-year mortgage would be better if you can afford it. But what if you're in an area where everybody makes pretty good money and home prices are likely to go up and a 50-year is your only way to get in? Well, you're going to miss out on all that equity if you don't do it at all. This isn't risky like the sense of an adjustable rate mortgage. It's still a fixed rate. You still have to qualify with a debt to income ratio, just like every other thing. The biggest downside is the rate will be a little higher. We're assuming this, but I'm sure it will be. Maybe a lot a bit higher, maybe not a little bit higher. But you're just a bigger chunk of your payment is not, I said that really poorly, of your payment, a smaller percentage pays off the principal and a bigger percentage goes to interest. Now, if we're going to come out and immediately jump all over the people who choose for that, we also need to jump on the 30-year fixed rate people that could have got a 20. And we got to jump on the 20-year people that could have got a 15. Because the lower your AM rate, the more, or your AM length, the more money you're paying yourself when you pay off your principal. And I never hear complaints about people that choose a 30-year over a 25. What are your thoughts on that?
It's because it's been standardized. It's standardized, right? I mean, that's the 30-year fix is what's sold in America. Once again, we sell 15-year loans. It's once again the vast minority. Not a lot of people take them. They don't like the higher monthly payments. Now, we may be a little bit skewed because we deal with mainly investors. But even individual buyers, you are right. We have a lot of people that qualify for 15-year loans and they elect for 30 years. And by your logic, it's the same argument as 30 going to 50, right? It's literally the same exact thing. If you qualify, why would you do it? And the answer that people have defined is they're willing to make that 15 to 30-year jump. Will they be willing to make the 30 to 50-year jump? I don't know. It's impossible to tell because I've never taken a 50-year mortgage application. It's not a real thing right now, right? But it's possibly something that the market will determine that we're up for this, right? Yeah. I can just see a concern where it's I don't want to say forced on people, but if it becomes the standard the same way X number of years ago the 30-year mortgage did, maybe it ends up being a nothing burger, like Trump said, like you let off with. It's very possible. Maybe it just ends up being a niche, like a fringe product. Very possible. I just don't know how I feel about it becoming the standard mortgage in America.
That's your fear. That everyone just goes, hey, lowest payment I can possibly get. Correct. I'm doing it. Because what this would do, if it became the standard, like you're saying, it's almost guaranteed to push home prices higher. Because now everybody can qualify to get a more expensive house.
100%.
Right. All right. Let's take a couple questions here before we jump off and let everybody get about their night. From Constellation. Can't this 50-year mortgage still work in a buyer's favor if they pay it off early by paying more than the monthly payment whenever they can? What's your answer here?
Yeah, the answer is that holds true for any amortization. You can pay a 15-year loan off in 5 years, right? No matter what your amortization is now. I tell people this sometimes. I'd say, hey, let's say we're comparing a 15 and a 30. If you select a 15-year, you have to make that higher payment. You have to. That's your minimum payment. It's a higher monthly payment than the 30-year counterpart. So you're forcing yourself to pay it faster. But people forget to realize that you can pay a 30-year loan off in 15 years by probably throwing an extra $1,000, $2,000 a month at your mortgage. Yeah. You can do it. The nice thing is that the 30-year fix gives you flexibility, where if you have a tough month, you get laid off from your job, your Airbnb doesn't rent, you have a lawsuit against you, you have a kid going to college, you have whatever, all your life events that could happen, you can drop the monthly payment back to that 30-year minimum. And once you kind of right the ship and maybe get in a stronger financial position, you can pay that extra again, and you can still track to be in on a 15-year payment term.
Now, I think
I'm kind of arguing against myself because the same argument can be made for a 50-year. I get it. It's just hard for me to justify because I've done 10,000 30-year loans in my career. It's a friction point, right?
Well, I think Constellation's logic, I'm speculating now, but I think I know what they're getting at is if the payment is lower on a 50-year than a 30, couldn't you take the delta and put it towards the principal to pay it off faster than a 30? But my guess would be the delta, how do I need to articulate this the right way? The 280 that you're getting that you put towards the principal, you already would have been paying more of that off towards the principal on a 30-year. Am I articulating that well?
The only piece that's missing in that argument is the differing interest rate.
It's worse on a
50-year fix is going to be, so that same amount of money dedicated to your payment, your minimum interest payment is going to be much higher, right?
And I'm trying to think of the right way to explain this to someone who doesn't understand mortgages like you.
I think the delta would still work against you.
Because the rate's higher.
Because the rate's higher. If the rate was exactly the same, like if 15 and 30-year fixes were the same right now, I would never sell a 15-year loan. Why would you? The rate's the same. Just pay your 30-year loan off in 15 years, plus you get flexibility, right? The difference is that in jumping to the higher amortization points, you get a bump in interest rate. That's what kills the margin there, right? That's what kills the arbitrage.
If the rate was the same hypothetically and you took the delta and put it towards the principal, you wouldn't pay it off faster because that difference would have already been being paid towards the principal on the 30 if the rate was even. Okay. So like you're not really paying the 50 off faster than the 30 because you got 20 extra years of time you got to pay it off versus the 30.
Correct.
Not only is it even, it's worse than even because the assumption is there will be a higher interest rate. So more money will be going towards the interest. So Constellation, I like your thought here, but no, it would work against you if you had a lower payment every month and put the difference towards the principal. It wouldn't pay it off faster than if you took a 30-year note and just paid it off on its normal term, because you also got 20 extra years of payments there. But you can take that principal of a 30-year note and you can put the payments towards the principal. You could do this on any mortgage that you have at all, but we would caution against doing this on the 50-year because your rate's higher. It's going to slow you down.
Correct.
You want to take that idea and get the shortest amortized period you could possibly get. In other words, it's not just paying the principal down with every payment that gets your loan paid off faster. Starting off with a shorter amortized loan does this for you. I don't know if we've articulated this as good as possible. It's really hard to talk loan nerd stuff with people that aren't super used to nerds. But let us know in the comments if you think that we didn't explain this well and you have any questions. From Faith Fueled Finances, cash depreciates and doesn't pay you rent. He's talking about how if you keep money in the bank, it doesn't actually grow wealth. Just thinking that, David, I'm 24 and would consider refinancing my rental because I invest the excess cash flow. Christian, if somebody wanted to refinance their rental, lower their payment, and then reinvest the difference, what would you recommend? Where's the first step there?
Yeah, we do it every day. The first thing is understanding the refi. If you can't make sense of how to access that equity and still have it make sense as a proper rental, then I don't feel comfortable pitching you to cash out of that property, right? It all starts with how we can make the current property look, and then we analyze what we could purchase with that money should it be freed up. So, I mean, obviously we can do a deep dive here, but I would just recommend, I just see Faith Fueled Finance. I'm not sure who that is, but whoever asked that question, if you just reach out to us, we can actually do a deep dive into your scenario. And you're 100% right. If there's an opportunity to refi and still make the cash flow from that property make sense and free up some capital for you to invest further, 100%. We do it for people every single day. That's a big part of our business structure.
Yep. He also said the pro would be a little bit more cash flow. The con would be less equity growth. And that most people think of equity growth as the asset appreciates. That is half of it. In Better Than Cash Flow, I talk about this. You do get equity growth when your asset appreciates. You also get it through loan pay down, but not the entire payment, the chunk that goes towards the principal. And the higher the period of time it takes to pay it off, the slower that happens. Correct. The lower the period of time, like a 10-year amortized note, you have really big chunks going towards your principal, not as much to interest. And that does supercharge how fast you can pay this loan off. And that is a legit wealth building strategy that really becomes more attractive when you're in a market, when you're not seeing a lot of actual asset growth.
Yeah.
We have not talked about this in years because freaking with all the quantitative easing, everything was exploding in value, and it would have been foolish to put your capital towards paying down your notes when you could be getting more real estate. But as we move into a stagnant market, I wouldn't say we're in a bad market right now, but we're certainly not exploding. It makes more sense if we did move into a bad market where real estate values were not appreciating anymore and it was all just kind of like frozen. I would be a fan of paying down mortgages faster and building equity up that way.
Yeah, there's not one strategy that persists through every type of market environment, 100%. And that's something that we take into account on every intro call we have, every borrower scenario that we review. What makes sense for you today? Not COVID, not 2008, not 2020, not 2011. What makes sense today in terms of how do we best analyze your portfolio? Or if you don't have a portfolio, how do we get you into a property that makes sense with today's market in mind, right? It's a big part of it. All right. I'm going to grab another question here too, David, because I saw somebody ask, and I want to answer this because I have it up on my calculator. They delete their payment? No, right here. So Hard 10 Music asks, what are the payment differences of a $700,000 house at 30 years and 50 years? I love this question. So
I'm just pulling that up right now. Do you have your calculator up already? I can let you do it.
I'm going to do it right here for you.
So I was going to let you talk and I was going to pull it up, but I'll talk and you pull it up since you can do that instead. I'll buy you some time here. So let's look at this. This is actually a really good question. And for those of you that haven't done this before, thank you, Hard 10 Music, for asking this. Christian's going to do this. He's going to tell you the difference in the payments at 30 years and 50 years with the assumption that the interest rate is the same. And then after we do that, we'll run one where we actually bump it up a point, because that's where I'm guessing it might be even more than that. But we'll bump it up a percentage point and we'll cover what the payments would be. Let me know. You good, Christian?
I'm good. I'm good for the first one. Yeah. So I'm just going to use a 6.5% rate. Current market rates are a little bit lower than that, but maybe you're buying a rental. So we're going to use 6.5 as our market rate. We're going to first run it at a $700,000 loan with a 30-year term. That payment is $44.24. Okay. So put down $44.24. Everybody here, I'm going to write that down somewhere just so I have it. $44.24. I'm going to now take up that to a 50-year loan. David asked me to make the assumption that the rate is not changing. This will probably not be true, but we'll make the assumption if the rate doesn't change, it goes to, let me make sure I did that right. So $700,000 loan, 50-year term, 6.5 interest. We're now at $39.46. So I can do that exact math, 40 minus $44.24. It's a $477 delta, which makes sense because the example they put on the video that we watched when we started this off was about a 270 difference, but this is a loan amount of almost twice as much. So $500 roughly, $478 difference per month. So that's something that if we did have this at our disposal, we would address. Hey, are you willing to sacrifice a significant amount of equity pay down in the first few years of your loan? Are we willing to sacrifice 20 more years of payment history for a $500 a month increase in cash flow? Maybe. That's up to the market to decide. I don't know, right? I can't answer for you guys. But that's what a potential would look like. What would probably more align with what will actually happen is that interest rate bump. So I'm now going to compare our $700K loan, 30-year fix at a 7.5 rate. And David, I think you're right on the button. I'm going to use a 1% rate increase to go to a 50-year. So we're going to instead go from 6.5% to 7.5. And that payment is now $44.81, whereas we started at $44.24. So $44.24, 44, whoops, minus $44.24. Wow, interesting. It's actually more expensive.
What is?
I do that right here.
The 50-year loan is more expensive?
Yeah. If it's a 1% rate increase, it's almost the same amount. So our 30-year was $44.24. If we do a $700K loan, 50-year term with a 7.5 interest, it's $44.81. It's $40 more expensive.
And the difference, and that's because if the rate goes up, you lose the benefits, right? And so we don't know how this is going to work out, but this is what I was afraid of, because when they were showing examples of the $400,000 loan, I'm like, I would have thought the savings would have been more, right?
They're assuming the same rate.
I think the way that, yeah, and they're assuming the same rate. That's exactly right. I think the way the math works out in these scenarios is that the bigger the loan amount, the less benefit you're getting stretching it into the 50. That's what my guess would be about how this works out. And that means if they want this to actually be a useful product, they're going to have to subsidize the rate on a 50-year note. And they're going to have to keep Fannie.
Oh, you said the dirty words. That's so true. Everybody, if you just capture what David just said there, they said in order for this to work, there would have to be a subsidy, which is basically the government coming in and throwing in some coins. How do we help? How do we help? In order to incentivize the investors to purchase these types of loans. So now we're not only talking about 50-year fixed, how does that benefit borrowers? We're also talking about that taking a hit out of the American finances. Very interesting. And I do think that you're probably right, unfortunately.
And the borrower, why are they going to do it if their payment goes up? You're getting all of the negatives and none of the positives. It becomes the nothing burger. So I wouldn't have everyone panic like you're watching. We just got a bunch of panicans right now that are freaking out about it. It doesn't even make sense. And then to further complicate this, you and I have been talking on Mortgage Money. By the way, if you guys aren't subscribed to the David Green Show, you can send me the word podcast on Instagram at David Green 24. You'll get some links because we talk about President Trump has been discussing, do I want to decouple Fannie Mae and Freddie Mac from the federal government? If he does that, you have less control over the subsidies. How do you even accomplish getting this thing passed? It doesn't make sense to my mind. He's got to have some trick up his sleeve that he's on one hand talking about getting rid of Fannie Mae, Freddie Mac. And on the other hand, he's talking about adding a 50-year mortgage that only works if the government is in control of it. So I don't know how this is going to play out. I'm thoroughly confused, to be honest. I haven't heard anyone else discussing this. They typically just jump in and get all outrageous in the 50-year mortgage. Look at all the interest you're going to pay, as if people pay their houses off in the first place. That never happens. Squishmallow says, or sorry, Woa nah. Some people love interest only on commercial properties. Interest only loans on commercial properties, more cash flow. Yeah, that's true, but it doesn't save you as much as you think, because very little percentage of your loans in the beginning or payments are going towards principal. So your cash flow doesn't explode like people think on interest only loans.
And the big difference of commercial loans is that they're on shorter terms. So usually commercial loans are like a 5-1 or a 7-1 arm. So the principal reduction that you receive in 5 years is not usually justifiable to pay principal and interest.
Yeah, they're usually like a 20-year amortization or 25 amortization. And then in 5 years, you got to refinance it anyways. And those first 5 years are almost negligible.
Exactly right. The danger with commercial lending and why it's in the gutter of where it is right now. Say hi to the mortgage mutt, by the way. The reason why they're in a little bit of the rut that they're in right now and why commercial is much more responsive to the market is because you get into the refi cycle. You almost have to refinance a commercial property every 5 years, unless you get a 7-1 or a 10-1 arm. And you guys can imagine whatever 5 years ago, what was happening, right? All those people are refinancing right now that were given 2.5% and 3% rates. They're now having to refi at a 7%, and they're shocked when they hear that my property doesn't work at a 7%. Well, yeah, you bought it at a 2%. Of course it doesn't, right? That's almost that's more than 3xing your interest rate. It's not going to work, which is why I don't know how much you guys follow commercial. I know that we're traditionally more residential in nature. But traditional is running into its whole own problems because of exactly that concept. Interest only and adjustable rate mortgages. They're tricky. They're very tricky, especially with short-term, very aggressive market changes like we just experienced the last 4 years.
Squishmallow Lover says, just tapping in, any prepayment penalties? We don't know. They haven't released anything. This isn't even a real product yet. It's a proposal. My guess would
they put a prepay on a 50-year. That'd be a very interesting decision.
I think that's why he's asking, or she's asking. We're not sure who they are.
Yeah.
If it's a qualified mortgage, probably not. If it comes through the conventional pipeline. MCK says the 50-year will only help landlords that are never going to sell. Why not make it 1,000 years? If you're not selling, who cares?
Yeah, I can see that argument that if we already went to 30, if we now relent and go to 50, there's kind of a point to be made there. Like, would people take a 100-year mortgage? Maybe.
Yeah.
I don't.
And if the banks are packaging them up and selling them as mortgage-backed securities, there's a buyer for it.
You would think so. Yeah.
It's weird, right?
It is weird. It's where do you set this like reality and theory breaking point? Is it at 50? Is it at 100? Is it at 300? I don't know.
Well, that ties into this idea that money is not what we think that it is. It's really hard to explain this to the layperson that just doesn't understand the way money works, but it is not a real thing with an objective value. And that's why what would appear to be a crazy concept isn't actually crazy in practical terms. Faithfield Finances said, agreed, LOL, with a laughy face. The best thing that never happened, said exactly David in all caps. Way to go. Kanye West in the chat here with the screen name, the best thing that never happened. One day Oliveira says, isn't the problem with housing supply and cost? How does this help? You qualify for 50-year, yet gas, food, etc. goes up more than your pay by an exponential amount. That is a solid point too. This is not solving the problem of housing. We would need to build more houses. And even more important than that, we would need to get wage growth. And to get that, we would have to create jobs. That's what really would fix this. I don't know how you just snap your fingers and create jobs, because people got to want to work them. And if there's a huge social safety net where we give people health care and we make sure everybody's covered and we give people food benefits and we give people Section 8 housing and we give people education and we have equality everywhere, why are you going to go work a job when you don't have to? Or are you going to be really picky about the job that you take? And housing is very closely tied to job growth. So that's what we would have to fix. I think this is, I don't know. I think it's going to be a nothing burger.
Have you heard Elon Musk's response to this problem? Is it going to
be universal basic income and we're going to have robots do all the work and we're just going to have a higher quality of life?
To a degree. But he had such an interesting take. I'm not a huge Elon fan nowadays. I think he needs to get off of Twitter some days. But he had a very interesting take on this where he said, the concept of wages not growing, the concept of everything getting more expensive. If we actually attack it from the other side with automation, with AI, everybody talks about it from the standpoint of it's going to take all the jobs and nobody will make money. And the only logical answer is to go to a universal basic income society. But he said if the real goal is accomplished, the cost of productions would go theoretically to zero. Because you imagine an Elon Musk brain, if I generate all electricity from solar, I have robots doing all the work, they can build the cars, they can plant the food, they can do everything. He's like, the cost of things would go to zero because there won't be a business owner that has to make money there. So while we have to address the job situation, but he said, if I just am able to make things really, really, really cheap, it kind of fixes it from the other end of the equation. I thought that was really interesting. I don't know how realistic that is because he's also planning on going to his Mars in his lifetime. But I think it was a very interesting topic that not a lot of people discuss, where if we just really shrink the cost of producing things, which is what is the primary driver of inflation, because everything is automated, would that solve it? I don't know. If we just
it would make things cheaper. It
what
would
is
also make
farm,
wealth
right?
creation incredibly difficult to do.
Yes.
You would
Yes.
sort of create a big equilibrium for everyone, which there does seem to be a form of an agenda to make that happen, because it's a great way to get elected, right? There's a higher percentage of people that are sitting below wealthy than that are wealthy, and you can get their votes by a proposal exactly like this.
Somebody just did that in New York.
That's a great point. Yes, that's a great point. Yeah. MCK says, nothing I purchase I plan to sell, but I always have several exit strategies. Squishmallow says non-Q. Let's assume they're asking what that means, because I'm assuming you said it. Can you just share what non-QM refers to?
Yeah, non-QM is a non-conforming loan. So everything that we're talking about with Fannie Freddie and what they're rolling out with these potentially 50-year fixed and everything we're talking about, non-QM is all the lending that does not follow those rules. So if you guys follow us, you probably know about the DSCR loan. The DSCR loan is a non-conventional loan. It's not underwritten the way Fannie Mae and Freddie Mac do. It just means it's a mortgage that doesn't conform to the standard set by Fannie and Freddie.
During the Dodd-Frank Act, they kind of created this idea of what qualified mortgages would be. Great there. So if somebody comes to us and they say, hey, I want a DSCR loan, I want a fix and flip loan, I want a bridge loan, I want a commercial loan, a lot of these don't fall within these standards of conventional financing that Fannie Mae and Freddie Mac make sure will be bought or provide. MCK says, really good show today, boys. Thanks. Well, thank you all, or actually thank Christian the most for being here today. He's trying to squeeze this in around serving our clients and trying to not starve. His glucose levels were plummeting, but the news was summiting, and I had to pull him away.
I was going to comment that is the first calorie I've ingested today, so I had to do it.
I believe it. So that's how much we love you guys, especially Christian. Faithfield Finance says, can't you do principal only? Maybe I don't understand what he meant. This is a good point, right? Because we talked about interest only. Let him know why a principal only loan would never happen.
You can do principal only on the extra payments, but you got to pay your lender your interest. So when you pay, like if your minimum monthly payment is $3,000 a month, and where you are on your amortization, you're paying $2,500 in interest and $500 in principal. If you instead made a $4,000 a month payment instead of $3,000, that entire extra $1,000 does go to your principal. 100%. That is a principal only payment. However, you can't get a principal only loan because then your bank would make no money and nobody's going to lend you money and make no money.
Yeah, right. Basically a principal only loan would be at 0% interest. So
that's correct.
You let me borrow money, I pay you back $1,000 a month, and that's all going against what you let me borrow. You're not making any money on it as the lender.
That's that loan that came from your wealthy uncle who really loves you.
Right? Or maybe your creative financing deal where, you know, you're paying more for the house than what it's worth, but they're financing you at 0% to make up for the extra purchase price. But you're never going to get a lender that lends money with the principal only loan because then they don't make any money. I think it's maybe if there was some kind of like crazy upfront closing costs or something like that, but that's not something we ever come across. Constellation says, I only asked because I thought it would provide flexibility for an investor to have more cash available for another investment. So he's probably referring to his comment about a 50-year not paying it off faster. But if you had more cash left over, you could put that into buying your next house. So Constellation, that is a good point. That would work. if the payment was lower, but when we ran our projections, it was actually higher to go with the 50-year than the 30 because of the higher rate. So we don't know how this is going to work. And here's another thought, Christian. If they do subsidize it, that would lead to the 50-year mortgage sort of taking the place of the 30 as the standard mortgage.
Which is
That's
what I
your
love.
fear.
That's my fear.
That's exactly right, which maybe that is what's going to happen, because as we just ran the math, it doesn't math if you let the rate be higher like it should be for the lender. So it may be where Trump goes and twists the arms of Fannie and Freddie, and he's like, I need you guys to give the 30-year terms on a 50-year, and this is what you're going to do, and we're going to set it in stone, and then we're going to do this before we privatize this, and we make them public so that people can buy into this thing, to try to cement this policy in place for future generations to be able to get a 50-year mortgage. And then Christian's greatest fear will have become a thing, and we will look back at this show as a monumental time in the world of mortgages. Yeah. California Wine Guy, join late. Have you discussed inflation-induced debt destruction? Yeah, I think we covered that a little bit in the beginning. That's sounds like the name of a sci-fi movie, doesn't it?
Inflation-induced debt destruction.
That is what we've been seeing. Is they print more money, money becomes worth less because there's more of it. And you have to invest it wisely in order just to stay even. This is covered in my book, Pillars of Wealth. If you guys want to go pick that up, you'll get a much better understanding of that question. Where can I find your brokerage? Best question of the day. I need to get like lights and sirens that go off whenever somebody asks that. Christian, how can
Panda Express, and they have when you donate to like the child fund or whatever, they ring the bell. Yeah, they ring the bell. You never see that? I don't know. Maybe it's just a California thing, but they ring the bell when you donate to the Children's Hospital. I don't know. I just thought of that.
Well, that was a great point. I just had never heard of it before. Where can they go to find the One Brokerage?
Yeah, 100%. You can find out more about what we do at theonebrokerage.com. That's our website. Best way to find me, if you just want my advice and guidance, is at The One Broker. Best social media for me is Instagram. That's one I'm most active on. And most of stuff of what David does, if you guys ever message him directly or respond to this YouTube thread or send him a DM, he can always connect you to me as well. Me and David own the One Brokerage together. If that's not, I think everybody knows that, but that should be disclosed as well. This is mine and David's business together. So if you trust David, if you like what I have to say, if you enjoy events like this and you want to trust us with your business, that's how we make our livelihood. So we value our clients, and we appreciate you guys spending a holiday night with us here on Veterans Day.
Christian is not just my homie. He's not just my brother. He's my bromie. And so that's why he's on the show today. And if you guys want to get a hold of me, you could do so right now. In fact, if someone wants to test me on this, go to davidgreen24.com. There's a little chat button. Hit it. Send me a message while we're still live, and I will prove that I am real, and you can get a hold of me. I prefer, if you guys are going to try to contact our brokers, that you reach out to me, and then I can connect you with somebody directly. We do occasionally have human error where the person answering the phone doesn't have reception, or our emails go to your spam and you don't see them. So you guys can go look at our website, theonebrokerage.com. You can reach out to Christian on his Instagram. You can email us, intake@theonebrokerage, or you can hit up davidgreen24.com, use the chat feature. I'll ask you some question about what state you're in, the type of property, the overall goals you have, and then I will connect you with the person I think will be like kind of the expert in that area. 100%. A half point will only give you $200. F my life, still a dead loan option. Yeah, it just wasn't when we looked at it. Christian and I are both.
It's very surprising. It's very surprising.
We thought it would be bigger than this, and it's so weird that the news people themselves, Christian, aren't talking about how it's kind of a non-factor. There's not a lot to why it would benefit you for as much as people are talking about it. I heard non-qualified would have penalties. Those are probably prepayment penalties that he's referring to when you get a non-qualified mortgage. Field Finance is now asking about the crypto-backed dollar. This is probably something that Christian has spiraled into on Reddit at 2:00 in the morning when he can't sleep and he's taking a break. Is there anything you want to share on what you think about the central current digital currency?
I think it's coming, but that's a little conspiracy theorist, but I do think
maybe we'll do another show on that.
Yeah,
we'll do that.
I do think we'll probably see a crypto-backed dollar in our lifetime.
Squishmallow says thank you. Nuna says a proper kosher loan. I'm sure that has something to do with like Jewish laws regarding lending that I don't know of. So I'll take your word for that. Is there a DSCR cash out refi loan? Why, Jonathan? What a wonderful question. Christian, can somebody do a refinance with DSCR principles?
100%. Any loan that is available on a purchase is available on a cash out. There are no exceptions. Any loan that you ever hear us talk about, conventional, FHA, DSCR, hard money, probably wouldn't want to refi into hard money. Usually you're refining out, but you could theoretically.
Yeah.
But yes, every loan product that we ever discuss is available for both purchasing and cash outs.
Isaac says, what adjustment points come with a 50-year mortgage? Well, I know the short answer is we don't know, but is there anything to add to that, Christian?
We don't know. It's not a real product yet. So everything we're thinking, the delta between, we covered this a little earlier, but the delta between a 15-year and a 30-year is about 0.6 to 0.7 points right now on average. Probably that, maybe a little bit more because it's 20 years, not 15 difference. Maybe 1%, but at 1%, we just ran through the numbers together. It would make your monthly payment higher than the 30 years. So there's no reason to do that.
Yeah.
But yeah, probably, I don't know. Not to just repeat what we said, David, but it would probably require a government subsidy in order to make it make sense, which maybe Trump's working on something that isn't.
That's scarier than we thought, though, because like we said, if he is, then it has to replace the 30-year. There's no other way to make a 50-year mortgage work if you don't subsidize it. And if you're going to subsidize it, everyone's going to do it. And it would replace the 30-year mortgage. So maybe it's bigger than we thought. Basically, we're discussing George R.R. Martin saying, I think I'm going to write another book in the Game of Thrones series or whatever. And we're like, what do you think it's about? We don't know. He hasn't put out the book yet. We're talking about what it might be about.
But he said he's thinking about it.
Yeah. Yeah. Like, well, what could Jon Snow be doing in the sequel?
Yeah.
That's basically what we're discussing here. And there's a whole lot of people with opinions about if they think another book should be written, if it's a good idea or a bad idea. California Wine Guide said, I recently did a DSCR cash out refi at 575. This is in response to an earlier question where someone said, can I get a DSCR for less than conventional? This is probably a good point to jump in here. Now, he's saying he got it at 0 points. Is there anything you've seen, Christian, where someone could get a DSCR loan below 6% with 0 points when that's less than the conventional rate?
So you can get a DSCR at 5.75 with no points. I would say I'll pay you $50 right now if you send me your closing disclosure.
Where can he send it?
Christian at thebrokerage.com. And I will tell you if you didn't pay points, it's very possible that maybe you had like a 20% loan to value loan. I don't know. Maybe it's a 5-1 ARM, not a 30-year fixed. I don't know. Maybe it's a commercially backed loan. I don't know. There's a lot of maybes there that would potentially lead to that number. If it's a 30-year fixed DSCR cash out refi with no points, I would pay you $50 to send me that closing disclosure and prove that you closed it, because I don't believe you.
Do you think there's a catch somewhere? Maybe it happened
somewhere that maybe was not explained to you. Maybe they rolled in a bunch of costs to your loan amount. I don't know. If you really got that, you got a hell of a deal. Good job.
It would probably have to be something like your dad was the mortgage lender and they waived all compensation or something like that. Like there had to be something.
Yeah, even waiving all comp, the baseline is not that low right now.
Still that, okay.
Also, if you did that with a bank and you have $2.5 million in a checking account with them, it's possible they did a negative. Yeah, you put 60% down. Okay, that makes sense.
So there's lenders that will do
40% loan to value. Yeah, you could definitely do that at 60% down for sure.
Okay. Now, this isn't what happened with California Wine Guide, but I think people should be aware of this. Many lenders, because there's so many ways to be dishonest, we have this problem at our brokerage where we have people that approach us and say, hey, give my loan. It's a dishonest loan. They don't say it like that, but we realize it is. Or we have people that have worked with us in the past that wanted to do dishonest loans, and we said no, and they left and went and did something with somewhere else. We don't play that game, but we know how well it's played. We know the rules. And there is a way that lenders will approach you and say, hey, do you want to do a cash out refinance? It's a no-cost loan. And what that sounds like is you're getting a free refinance. But when they're calling it a no-cost loan, what they're really doing is they're saying you don't have to come out of pocket for anything.
Correct.
Because they're just adding it to money that you're borrowing. Are these things
or they add a $4,500 lender fee and say you're not paying points? Yes, you are.
They just called it a different name,
They just
right?
called it something else. It's so silly.
Yeah, that's so easy to do in lending, everybody. Christian and I, we've done shows on Mortgage Monday where we talk about common ways people can create a different name, move it from here to there, send you a loan estimate that doesn't have certain numbers on it that they legally can leave off because they can't know for sure. But then they put those numbers somewhere else to make the loan look different than it is. It's so easy to rip people off in the business. I'm just being honest with you. If we wanted to do it, it'd be very, very easy to do it. And that's why we're here. We don't want to see that. We don't want to see your mom get ripped off. We don't want to see your aunt get ripped off. We don't want to see someone who doesn't speak English well and can't understand the terms get ripped off. And we know how common it is because we've had to lose employees that wanted to do this and we told them no and they went to work somewhere else. In fact, many of you may think you're working with someone that is us that's not, because they still brand themselves like they're with our company, but they wanted to rip people off. So it's very important, if you guys are looking at refinancing, getting pre-approved to buy a house, whatever it is, that you talk to me and let me connect you with someone, or you talk to Christian and let him work with you or connect you with someone. Do not reach out to someone who says they work with us or they are us to get your business. I mean, I literally get calls from people screaming at me because this horrible loan that someone gave them that they found out about, and the guy doesn't work for me anymore. He left because we wouldn't let him do it. So we'll give one last chance, Kristen. Where can people find you? And then we'll let everybody go about their night and have a happy Veterans
At the One
Day.
Broker on Instagram or our website at theonebrokerage.com. If you submit an inquiry on our website, a real person will reach out to you.
All right.
There's nobody who's got access to our website. What Dave is saying is people maybe be marketing, maybe marketing on our behalf with a David Green logo or Bigger Pockets logo because they previously worked for us. That make sure you go through us because we can connect you to the people that we actually work with.
There you go. Thanks everybody for joining. Thank you for your time. Please subscribe to the show so you get notified when we go live in the future. As new information comes out about this, we'll be jumping on to share some of the details. We're also going to be going live to talk about what the heck is going on with the real estate industry as we head into the winter months. So Christian, thanks for joining me today. I'll talk to you tomorrow and I'll see all you guys later.
Absolutely.